Welcome back to the Deep Dive. In today's economy, it's really interesting to see how different sectors are navigating things, especially when there are headwinds.
Right. And today we're digging into a big one, the luxury home market. How does a company like Toll Brothers keep performing?
Exactly, Toll Brothers, Inc. We're looking at their latest financial results. They call themselves America's luxury home builder. Fortune 500 company, been around since, what, 1967?
Yeah, 58 years, publicly listed, ticker TOL, and they've got a reputation. Fortune's world's most admired companies list for over 10 years.
And their CEO, Douglas Yearley Jr., he was named a top CEO by Barron's. So definitely a major player with some serious credentials.
So what we want to do for you today is pull out the key insights from their Q3 results for fiscal 25. That ended July 31st. We'll compare it to last year, see what's changed.
Yeah, the goal here is to give you a clear picture of the luxury housing scene, what's driving it through Toll Brothers' lens, without getting totally swamped by the numbers. So let's get into it. The CEO started off saying it was another strong quarter. Okay, but what does strong actually look like here?
Well, strong for a luxury builder, you've got to look at revenue and deliveries, right? Home sales revenue hit a record $2.88 billion for Q3. That's up 6% from last year.
Okay, record revenue and deliveries.
Deliveries were up too, by 5%. They delivered 2,959 homes, and the average price tag on those delivered homes, about $974,000.
Wow, nearly $1 million on average. So the top line looks good. More homes, more money overall. But what about profitability? Did that growth, hit the bottom line?
Yeah, that's always the key question. Net income was actually down just a tiny bit, $369.6 million compared to $374.6 million last year.
Oh, okay, so slightly less profit.
Slightly less net income, yes. But, and this is important, their diluted earnings per share, EPS, actually went up to $3.73 from $3.60.
How does that work? Less overall profit, but more per share.
Often show buybacks, which they did. But also look at their margins. Their adjusted home sales gross margin was 27.5%. That beat their own guidance.
Ah, better than they expected.
Right, by 25 basis points. And their SG&A cost selling, general, administrative that improved too, down to 8.8% of revenue. So even if the overall gross margin tightened a bit from last year, they were managing costs really well. Very efficient.
And that efficiency, I guess, gave them confidence to return cash to shareholders.
Absolutely. They bought back about 1.8 million shares, spent over $200 million doing it.
Wow.
Add in dividends, and they returned about $226 million to stockholders just in Q3. That's a big signal of confidence for management.
Okay, so Q3 itself was strong, efficient, shareholders got rewarded. But what about the future? What do the new orders look like? This is where it gets interesting.
It really does. So the value of net signed contracts was $2.41 billion, basically flat compared to last year.
The value, it's okay.
But the number of homes they contracted for actually went down 4% to 2,388 units.
Hold on. Flat dollar value, but fewer houses.
Yeah, exactly. The average price per new contract jumped up 4.5% year over year to hit $1.0 million.
$1 million average for new contracts.
Precisely. And that's what's fascinating. Flat value, fewer units. It tells you a lot about the luxury segment. These buyers, they're maybe less bothered by interest rates. They want the quality, the location, the brand.
So Toll Brothers can push prices higher even if they sell slightly fewer homes.
It suggests they can. They seem to be optimizing for profit per home, not just chasing volume, which, makes sense in a market with affordability pressures elsewhere.
And the CEO's comments kind of backed that up, didn't they? Mentioning the resilience of their affluent customer base despite the broader economy.
Exactly right. He talked about strategically balancing price and pace. That's the key phrase. They want profit and returns.
Not just selling houses as fast as possible.
No. And they're managing their spec starts homes built before a buyer is lined up very carefully, community by community, matching local demand. It's not a blanket approach, it's tailored.
Okay, tailored approach, higher prices on new contracts. How does that feed into their backlog? The pipeline of homes they sold but haven't delivered yet.
Right, the backlog. The total value was $6.38 billion at the end of the quarter. That's actually down 10% from last year.
Down 10% value.
And units?
Units in backlog were down more, 19%. So 5,492 homes waiting to be built and delivered.
Fewer homes in the backlog. But wait, let me guess. The average price.
You got it. The average price per home in the backlog shot up. It's now $1,161,000. Last year, it was $1,044,000.
Over $1.1 million average price in the backlog, so even fewer future deliveries locked in, but each one is worth significantly more.
That's the story. Now, this does raise a question for you listening. What does this mix tell us? Fewer units in backlog might suggest a slower pace ahead, maybe.
Or just reflecting that focus on price over pace.
Could be. But the much higher average price bolsters future revenue expectations per unit.
Right.
We should also mention cancellations. They did tick up a bit.
Oh, how much?
As a percentage of the backlog at the start of the quarter, it went from 2.4% last year to 3.2% this year. And as a percentage of contracts signed in the quarter, it went from 6.4% to 7.5%.
So a small increase in cancellations. Is that worrying? Well, it's something to watch. But for a luxury builder focused on maximizing price, maybe a slight uptick in cancellations isn't the end of the world if they're still hitting those high price points on the contracts that stick. It might be part of that strategic balancing act.
Right. Balancing price and pace might mean letting a few deals go if needed. Wait, let's switch gears a bit. Financial strength and land strategy. How solid are they financially?
No, very solid.
Yeah.
They ended the quarter with over $850 million in cash.
Just cash on hand.
Yeah. Plus, they have almost $2.2 billion available in their credit line, huge liquidity, and they've been smart with their debt. They issued new longer-term notes at 5.6%.
Okay.
And used some of that to pay off older notes that were due soon anyway, which had a rate of 4.875%. So managing their debt profile actively.
Extending the maturities, locking in rates, makes sense. And their overall equity position.
Growing nicely. Stockholders' equity is up to $8.1 billion. Book value per share is now almost $84, up from about $77 at the end of last fiscal year.
Strong balance sheet, then. Low debt compared to capital.
Yep. Debt to capital is only 26.7%, and if you net out the cash they have, the net debt to capital is even lower, just 19.3%. Very healthy leverage levels. Gives them a lot of flexibility.
Okay, so they have the financial firepower. How are they using it for future growth? Let's talk land. You mentioned they're highly selective and disciplined.
Yes, and that's crucial. They control around 76,800 lots for future building.
76,000, wow.
Yeah. Now, they don't own all of them outright. About 43% are owned, so roughly 32,800 lots. The rest are controlled through options or other agreements.
Still, owning nearly 33,000 lots is substantial. And they're still buying.
They are. In Q3 alone, they spent about $433 million on land, buying around 2,755 lots. But the CEO emphasized they have enough land controlled already to support growth for several years.
Which allows them to be picky, that highly selective and disciplined bid again.
Exactly. It's not just about grabbing land. It's about grabbing the right land in the right places at the right price. Because they have that pipeline, they aren't forced to chase deals. They can wait for opportunities.
That seems like a huge strategic advantage, controlling future supply like that.
It really is. It lets them manage inventory precisely, avoid getting stuck with land and cooling markets, and focus on high-demand areas. And they're active across a lot of communities, ended the quarter with 420 selling communities.
Okay, 420 communities. That brings us to geography. They operate across, what, 24 states plus D.C., 5 regions?
Yep, North, Mid-Atlantic, South, Mountain, and Pacific. And you definitely see different stories in different regions.
Where were the standouts in Q3?
Well, the Pacific region, think California, Washington, just continues to be on another level with pricing. The average delivered home price there was over $1.5 million.
$1.5 million.
And the average price for new contracts signed in the Pacific, over $1.8 million.
Wow.
And the homes in backlog in the Pacific have an average price of over $1.9 million. Just incredible numbers.
So the Pacific is clearly leading on price. Where did they sell the most houses?
That was the South region, places like Florida, Texas. They delivered 932 homes there in Q3.
Okay, higher volume in the South. But I bet the average price was lower than the Pacific.
Oh, yeah. Still high, but lower. Average delivered price in the South was around $813,000. So you see these different dynamics, right? Pacific, scarcity, maybe ultra-high net worth buyers driving those prices. South, strong growth, maybe more volume, but still at a luxury price point. It shows they tailor their approach.
Makes sense. Okay, before we wrap up, what's their forecast? What are they telling the market about the rest of fiscal 2025?
They put out guidance. For the full year, they expect to deliver around 11,200 homes total.
11,000 homes, and the average price?
They're guiding to an average delivered price between $950,000 and $960,000 for the full year.
Still very high.
Right. And they expect that adjusted gross margin to hold strong around 27.25% for the year. SG&A costs also expected to remain well controlled, around 9.4% to 9.5% of revenue.
And community count growing.
Slight growth expected. They project ending the year with 440 to 450 selling communities. So the guidance signals continued confidence in maintaining volume, price, profitability, and expanding slightly.
Okay, so pulling this all together after this deep dive, what are the main takeaways for us? What does it all mean?
Well, I think it clearly shows the resilience of the luxury housing market, or at least Toll Brothers' slice of it. Despite wider economic worries, they're commanding high prices.
Right. That focus on price seems key.
Definitely. Their strategy of balancing price and pace, backed by a really strong balance sheet and that very disciplined land strategy,
Hmm.
it seems to be working for them. They're navigating things effectively.
It really highlights how the luxury segment can behave differently from the broader housing market. Different buyers, different dynamics.
Exactly. Value and strategic positions seem maybe more important than just raw volume in this space.
So let's leave our listeners with something to think about, a
Yeah.
provocative thought.
Okay.
Given this deep focus Toll Brothers has on affluent buyers, their really detailed management of land, pricing, everything, region by region, how well positioned does that specific model leave them, especially if interest rates stay tricky or consumer confidence wobbles more? Could their model let them keep thriving? Or are there unique challenges just for them because of that niche focus? And think about that ability to be highly selective and disciplined with land. How might that specifically shape the whole luxury housing landscape in the next few years?
That's a great question to ponder. How much insulation does that luxury focus really provide, and how does their land strategy play into that long term? Lots to consider there.